Hi everyone, this is Bag of Dawn, Stock Market Caddy. It's April 16th at about noon. Not a whole lot going on today. The noise level is increasing on the Contrary News Bubble channel. As you all know, about the only person we ever turn the volume up for is Rick Santelli. We think the world of Rick, and and occasionally we, either before or after we might hear something. It's interesting. Yesterday they were in panic mode, and today they're out buying risk. And God help you if that's your trading strategy, is to turn on that network and to try to, determine what the markets are doing. And having them chew your food. I mean, that's just not going to turn out well. It is not the way to go. But in any case, there is one thing I want to comment on, though. Rick Santelli, I think he traded everything in his day, and I'm going to try to explain something a little bit further. I can't do nearly as well as he, obviously. I mean, we do trade bonds and interest rates. We're all basically interest rate traders if you trade anything. But he talks about something called the yield curve. And I wanted to, no, we don't trade the yield curve in and of itself as an indicator or what have you, but we are aware of what it is and what it means to people who do trade it and what it means to particularly the fundamental traders. And let me explain what these two charts are here. This is a dynamic yield curve. We're going to be able to manipulate this, and I'll be able to show you. This is the yield curve. This is a 3-month Treasury bill, 2-year, 5-year, 7-year, 10-year, 20-year, 30-year. This is the interest rate for a 3-month T-bill, probably what, 0.25, 0.30, 2-year, probably, I should know right now, but probably less than 1%. Um, the interest rate for the 5-year. Actually, by the way, well, this is on this graph. That's what it is. So it really, this isn't a reflection of today. I'm going to show you why not. But as the interest rates increase out over time, you can see that the slope of the interest rate is steep. And a steep or steepening yield curve, let's just focus on this chart, is perceived to be good for the stock market because, and this particular curve is not reflective of where we are right now today. I'm going to show you in a moment, but I just want to explain what this is. And the thought is that if the banks can keep your money in their bank, pay you very little for it, loan it back out to your neighbor as he goes buys a boat and goes to Europe, and borrows money, and he's got to pay back the bank at a higher interest rate. The differential between here and here, fattens up the banks, and that's good for the banks. Now, presumably, it's good for the economy because, or it's a reflection of a strong economy because people are borrowing, and and they're comfortable to borrow. When they're not comfortable to borrow, the interpretation is that things are getting not so good in out in the countryside or out in the cities. So, in any case, so this is the yield curve. Steep, presumably, is good reflection of the economy and good for stocks. Now, when it gets inverted, when it goes the other way, that many people read that, or flattening, read that into that it will flatten, and it can be an indication that the economy is slowing, and an inverted yield curve would be a recession. Now, over here to the right is the stock market. This is the S&P going back to 2000. So this was the crash in 08, 09, and then this is the huge rally. Now what I can do is, being that this is dynamic, I can take this line and I can show you what the yield curve was, and let's look at it right here, right in here. When the market was here back in 2000, look what the yield curve looked like. They were paying out, imagine this, they were paying out, this percentage and loaning out. It was inverted. The banks were actually losing money. And there just was no, they were paying out, the short-term interest rate, and there was no demand on the long term. And then look what happened here in the stock market crash. So let's just advance this here. I don't want to go through every period. And you can see here what happens is as the stock market crashes, we start getting recessionary. What the Federal Reserve would do, and this is Santilli used the word. He said they would be I forget the word he used. They would massage it. So they would drop the interest rate, the short-term interest rates, to try to steepen the yield curve to try to save the system. And so then look what happens down here at the bottom. Bingo. We got interest rates low, people are starting to borrow again, and look what happens. Ba-voom, market takes off, right? And now we got a rally on our hands. Now, look what happened right in here. Flat. Now, the market continued to rally, but let's look at the top. Okay, even right in here, pretty flat. And in here, you can see we're almost, we're flat. We're flat to inverted, and then, boom, down we come, and we crash. Now, it's down in here that you can see what the Fed was doing, jamming the interest rates low, trying to salvage, what they perceive the stock market or the economy by jamming and force feeding these rates low. So now, as we get here, you can see this is Bernanke land. Look how steep as we come out of here. Look how steep the yield curve is. We all know this now. This is all artificial. This is the Fed forcing it down. And look, as we go through, particularly even here, look at, this is in, 2012, 2013 as we're taking off. Look how steep everything is, because Bernanke still got his foot on the gas. He's still pushing these interest rates down. He wants this thing as steep as he can get it, and the market's, taking off. Now, let's come in here and look what's taking place. We're up here at the top. What we're seeing and what Santilli is commenting on, the yield on the longer, the 20 to 30 year, is beginning to flatten a little bit. And the question is, if rates are normalized, if the Fed takes its foot off the gas here, we are up here at the highs, and he wants to see what's there. These interest rates, if they were to normalize, they could come up here. And if the 30-year interest rates comes down, guess what happens? The yield curve flattens. Okay, now this takes time. If the yield curve flattens because there's no real demand, what happens over here? Well, we know what happened here, and we know what happened here. So that's the story of the yield curve. And it's so distorted, it's so artificial, nobody really knows. Maybe short-term interest rates should be up here, and long-term interest rates are down here because there's absolutely no demand. There's stories coming out now that the Federal Reserve has been lying about, loan demand. If there was loan demand, people really wanted to go out and borrow, the interest rates would be normalized higher. So is this the hint? And so this is real time now. Is this the hint of a flattening yield curve, that the interest rates are not going higher on the longer term money because there's no demand, and that if the Fed is backing away, which they've been telling us they are, if these things begin to normalize and go up, what happens to the yield curve when we're out here, and then thus what happens to the stock market? So you want to keep your eyes on a lot of different things, and they're doing a lot to fool you by artificially keeping the rates low, by hammering the volatility index. The Fed is hammering that volatility to keep you calm, keep you working, keep you believing, in this fantasy. They're doing a lot of different things, and that's why you don't we got Russia going to war with Ukraine, and the VIX is going south. It's a distortion, and nobody really knows what's real. So this is just one other thing though to keep an eye on. In the end, the market will teach the Fed a lesson, and hopefully you don't get caught in it. That's the story of the yield curve. Again, not something we use day to day, but something that you might want to be aware of if not already. And I hope we didn't bastardize it too much. I'm sure there are other bond traders saying you did a horrible job there. All right, good luck.